Welcome to Sir Lancelot's Real Estate Roundtable, your guide to mastering the realm of real estate in Central East Florida. I am Sir Lancelot Lenard, ready to uncover the secrets of seller strategies, home staging, mortgage mastery, and more. From Daytona Beach to Cocoa Beach, Lake County to St. Augustine, join me as we navigate the intricacies of real estate. As the leader of the Sir Lancelot Group at Florida Homes Realty and Mortgage, I'm here to arm you with knowledge and innovation, whether you're a seasoned homeowner or a first-time buyer, unveiling the kingdom of real estate, one roundtable at a time. Welcome back to another episode of the Real Estate Roundtable. I'm your host, Lancelot Lenard, realtor with Florida Homes Realty and Mortgage and leader of the Sir Lancelot Group. Each week, we dive into the strategies, stories, and secrets behind real estate success. And today's guest, let's just say he doesn't play checkers, he plays chess. Joining me today is Freddie Rappina, a former cop turned financial strategist, author of Playing the Wealth Game, and founder of Opta Financial. Freddie now manages nearly 100 million plus in client assets, and he's on a mission to show you how to think like the wealthy, even if you're living paycheck to paycheck. We're diving into how strategic debt, real estate investing, and mindset shifts can completely change your financial future. Freddie, welcome to the roundtable.
Thanks for having me. I appreciate it.
Hey, Freddie, let's get started from the beginning. So let's start with your law enforcement background. You were in there, you're doing it. How did that path lead you into the world of wealth advising?
I wanted to get into it roughly around my eighth to ninth year, and around my 12th year, I decided, hey, I'm gonna start something small, and so I started. I got all my certifications, started small, had the clientele be mostly the police officers and firefighters and all the retirement planning. And then it got really big, really fast. But I had my office right next to the police station. So I was literally running back and forth across the street after my shift or before my shift. It was crazy there for several years, probably around 7 years. And then I was able to retire from the police department and just focus on the firm. And it's been great. It's been great. We're very fortunate to have such a loyal clientele and continuing to expand.
Were there any habits or ways of thinking from your law enforcement career that shaped how you approach investing now?
A little bit. So the evidence-based mindset, right? So it doesn't take long. And when you're in law enforcement, you just don't believe anything you hear anymore. So really just investigating, okay, this is what's being said, but is this what's being done? And once I started getting around other, what I call chess players, other wealthy people, and understanding like how they thought, and it wasn't matching even what I was learning in classes. Even when I was learning in the classes of all the stuff that's behind me on the wall, I was a little bit different. And I was like, okay, there's two different games, and there's a little bit of a do as I say, not as I do attitude in the financial industry right now. So there's a lot of teaching checkers while they take the money and play chess with it. So I really wanted the world to understand that there were two different games. All right. And when I say that checkers isn't bad, right? It's not like checkers is bad or checkers is wrong. I'm just saying it's checkers and it's not chess. And the middle class has been force-fed checkers for so long. It's been 40 years, and the wealth gap in the United States is not shrinking, it's expanding. So there's evidence to something's not working, right? Something's amiss. And I think it just took somebody, a brash retired police officer, to say it out loud.
So, yeah, I imagine situation awareness must have translated into an interesting way. Does that come into play when analyzing risk or market shifts?
A little bit, but not. It's more of the mindsets, I would say. More of the looking at it from the under the hood perspective, and not just from an emotional standpoint. So yeah, that does help a lot, being able to like not let the emotions or the fears and all that stuff get you, and you got to stick with staying calm and doing what you're trained and what you know is true, regardless of what you're seeing in front of you. So that happens every once in a while, and especially maybe even it was a couple months ago now that the market took that big old dive
And then it
And
skyrocket up.
yeah, and it's just one of the things where it's if
I wish I had cash at that point because I was all in. I was all in on all my stocks, and it was like we were about to exit Amazon before it tanked, and we were like up 16% or something like that. And I'm like, the guy, my broker called me. He's like, "Hey, Lance, do you think we should sell?" I was like, "I don't know. What do you think? Thinks the earning call is going to be good?" I said, "Yeah, it's always good. We usually make 10% plus on the first quarter trade." And so I was like, "Yeah, okay, let's hold it." Then what happens? Tariffs. The CEOs announced that they're gonna sell 500,000 of their shares, blah blah blah, and then whoop whoop, 170. I'm like, God, I should have sold it at 200 and whatever it was.
But the way I look at all of that is the market doesn't create wealth the way people would like it to. It's a great storage of wealth. There's capital appreciation for sure in the market, but it's not a way to just let it sit and grow and everything's going to be hunky dory. It's that doesn't happen. And in my opinion, compound interest is one of the most oversold concepts to the middle class. Not that it's wrong because it's math and it can't be wrong. It's just human beings just don't live long enough for compound interest to do what people would like it to do.
Right? Thinking about compound interest at a 10% growth rate, or you're thinking about compound interest at a 30, 50% growth rate?
I'm thinking of it more along the lines of that 7 to 10% growth rate,
which is like an ETF, like a S&P or something like that, correct?
It could be a lot of things, but let's just say let's say you're getting 7, right? If you're getting 7, your money should double every 10 years. That's the math. But what I'm saying, and this is coming from the person who makes money managing assets, it's a good statement. What I'm saying is, how many sets of 10 do you have? How many decades do you have to live before this amount of money becomes enough money that you can draw a significant percentage of out and actually enjoy life? So I call that the golden wheelchair strategy. It's like, yeah, by the time you actually get to the number that you were looking for, strictly with that strategy, you may not be in a position where you can even enjoy it, or you might not even be on earth at all. So I want people to just rethink that, just analyze that strategy a little bit differently. Now, I'm not saying market-based assets are bad, of course not, right? I'm just saying it's a great storage, but ultimately, I think it is the best place for that create leverage, right? So when you go to a lender and you say, look at how much money I have, and you slam a nice statement on their desk and say, hey, I don't want to use my money. I want to use your money. Go in that back vault there and get me whatever I need to buy this cash flowing asset, which is typically real estate or business. Cash flow comes in, and that really allows your assets to grow. Oh, there's a lot of good tax strategies there. So it's just not the stock and it's going to double, triple. In my opinion, who really hits it well in the market are like people like secretaries and janitors that pick the right company, the right startup to work for, and get on an ESOP plan. And you're working, you're an admin at Amazon in 1997, and you pick the ESOP plan, and it's fantastic, right? But just picking and choosing stocks, like all that stuff, it's not the game that people wish it was. Let's put it that way. Getting loans, buying real estate, buying businesses, using your market-based assets as collateral, in my opinion, is one of the more faster ways to building wealth and building income that you can use for things like in my case, baseball and competitive cheer competitions. Those are things you enjoy spending money on, or at least I do. Yeah, so it's just a different way of looking at it. And that is chess.
Let's go to the next chapter here. Rewriting the financial rule book. Okay, you wrote a book called Playing the Wealth Game. What inspired that, and what's the main message you wanted people to walk away with?
Inspired because I wanted people to understand there are two different games, but it's just easy to say, right? It's harder to say which game are you playing, and do you want to continue playing that game? So I wanted to describe the differences between checkers and chess and have the book be more of a self-discovery book. By the end of the book, you should know whether or not you are a checkers player at heart or a chess player at heart, and whether or not you want to switch or stay where you are. All right. And again, I don't say there's anything wrong with checkers, but in my opinion, you're just not going to become wealthy playing checkers. You can be happy, you can be comfortable, you can do all that stuff. That's possible, but becoming wealthy, you're going to have to scrap that and move over to some chess strategies. And that's the biggest part of the book is understanding who you are and if you want to change.
So what does that look like in real estate investing? You speak a lot about checkers and chess. What does that look like in real estate?
Oh, in real estate investing, it's in my opinion one the most accessible amplifier to wealth. So you have the assets, you have the market-based assets, right? And you're able to obtain loans to purchase real estate. That will, if you're okay with having the debt, right? And debt is what's going to separate you from checkers to chess. If you want to play checkers, stay the heck out of debt. Have no debt. Pay off everything, including your house. If you want to play chess, though,
Dave Ramsey style.
If you want to play chess, though, you want to be in as much debt as possible without over leveraging. So they're two different mindsets and they can't coexist, right? So you have to decide where you are in that equation, right? But being able to use the assets, the market-based assets as collateral, at least as reserves, I shouldn't say collateral, reserves, right? So you have the money to pay back the lender if you wanted to, but you don't want to. You want somebody else to pay back the lender, and that somebody else being the cash flow from the assets, whether that be rents, whether that be the income from the business, whatever it is, right? But you want that to pay back the lender. Of course, you're going to have to put up some down payment, some capital up if you're starting a business, but it's a smaller amount. You're not purchasing it cash.
I got you. So basically, it's risk tolerance in a way. Is checkers is I can't deal with every day looking at a giant debt over my head or stocks going up and down, et cetera, et cetera. On the other hand, chess is okay. If I make this move, I can lose my pawn, but I can then knock out their queen or whatever. But so higher risk tolerance is what you're talking about a little bit, I guess.
I think it's more like different risks. Okay.
Okay,
Because
different.
I think there's a ton of risk to checkers, right?
Okay.
Because if you're playing checkers, probably have a salary, you have a mortgage, and like it's all hinged on if that boss comes in and says, "Hey, we're downsizing." A lot of things can unravel really quickly with checkers, and we see it pretty often in the economy. So I'm not saying there's no risk to checkers. I think there's a ton of risk to checkers. The risks are different. With chess, I think there's risk capacity, like how much risk could you do, and then there's risk tolerance, and those numbers that may be different, right? So
Yeah.
the risk tolerance can be different from the risk capacity, but there needs to be some form of risk tolerance there if you're going to take on a debt. But it's also the problem I see with the chess world is over leveraging. Like could you pay back? Could you make these payments if you didn't have the renter, if the business was in trouble, if there was another COVID, if they what could you weather the storm that's inevitable in any enterprise, right? So if you have the assets to be able to weather that storm, then you're not over leveraged. When you don't, and you're just taking on more and more debt, and you're building a house of cards, that's not a good idea either, and that's a bad trust strategy.
Got you. So, what do you think the biggest financial mistake is with middle class families nowadays? What do they make as their biggest mistakes? And how would a wealthy investor handle that same situation?
I would say just solely focusing on your job to create income. That could be a problem real fast because you don't have any say over the cost of goods and services, and it takes a lot with a salary to get above the cost of goods and services. When I say above the cost of goods and services, like how not just being comfortable or even being able to get by, you're not really concerned about the prices at the restaurant, a regular restaurant, right? I'm not talking about maybe the biggest restaurant in town, a regular restaurant. You're not concerned about how much it's going to cost at the end, how much your kids' activities are going to cost. How much is the Marriott in this particular city that you want to visit? Once you get above all that, then you're really comfortable, right? So not relying on the job for that, being able to purchase assets that will bring in income in addition to whatever you're doing for your day to day to bring in income to get you above the cost of goods and services. I think not enough people are doing, right? Even if they are playing checkers and simply not having the savings, not and a lot overfunding retirement accounts is another one, right? We see this a lot where people overfund 401ks, 403bs, whatever you got, and then they can't handle a small emergency and they have to pull money out of the 401k and things go haywire. So having a good balance when you have if you're playing checkers, you're playing chess, it's a totally different ball of wax and got to have the money first. That's just the one thing that I hear a lot of conferences that I go to, I speak at or attend is people want to jump right to chess. That's probably not a great strategy, especially if you're just starting out and you don't have the market based access yet, because you can't walk into a lender and say, "Hey, I have no money, but I'm all on board with real estate. Can I get a loan for a 10-unit apartment building?" They're gonna be like, "No, get the heck out of here." So there is a stepping stone to this as well. And I'm not saying it's easy switching over from checkers to chess. I'm just saying it's possible. And you can play the game on a much smaller scale too. It doesn't have to be this massive scale. It's all the same. It's just what level are you on and are you improving your level?
I always like to bring myself up as an example so people can relate to what's checkers and what's chess in this instance. Basically, I have a small multifamily, fourplex. I have my single family home. I have a couple cars, and I have about the same amount of cash invested as my real estate debt. No, a little bit more invested in the stock market as my real estate debt. So I could basically, if I wanted to, I could pay off all my debt. And I think I play chess in some way, but I'm not. Obviously, as we're talking now, and I'm realizing that I am more playing checkers at the moment, and I would like to play chess. So let's say net worth wise, about $1 million. That's about a good place where you could start playing chess, I think, isn't it? Or would
Yeah.
it be you could start playing in the lower numbers as well? But what's that magic
I wouldn't
kind
say
of?
there's a magic number, but I would say my goal is for our clients who work with us is I want to make you look really good to a lender, right?
Yeah,
If we're going to play chess, it's the lenders are what or who we're trying to impress to be able to get the debt to buy the cash flowing asset.
yeah.
So that answer is going to be different, but also starting small. I hear a lot of people say you should start really big, don't even bother with the small stuff. I'm like, yeah, but they started small. That's so
They
yeah.
bought a single
If
family home that they rented out and then they moved to the next one, burned it or house hacked it or whatever they did to get to the next level. And I always tell this to my military clients, guys, you move from city to city. Every city you move to, you should own a property in. You should not, you should own it and rent it out. And that's the way a lot of really wise military people have grown to the point where they have, let's say, 20 houses by the time they retire from the military. And they can live off pretty much, number one, their military retirement, and they can live off the rental income from their properties. And they can grow that at that point. They're like, okay, I have X amount of houses. Let's say three of them are almost paid off. Wow, I have a lot of equity sitting there. Now I could get into a larger multifamily where I'm going to settle in the
mhm.
town where I'm going to settle. And I think that's a great strategy for our veterans, or not veterans, but active duty military, to grow their portfolios that way.
Yeah, there's somebody here in Tampa that isn't a retired military, retired army, and he's built kind of a little following for himself with military people going doing a lot of those similar strategies. His name is Ben Smith. He runs the Magnolia Mastermind in Tampa. I like his group, and yeah, it's really about helping people get into it and get stable in it as well. It's just once you realize like how much the proverbial they own in real estate, that's when it changes your mind. And it frustrates me in the financial industry when we have so many financial advisors, whatever you want to call whoever,
Yeah.
financial professionals saying, no, you shouldn't invest in real estate, invest in the market, blah, blah, blah. And the buy mutual funds and the mutual fund company that we give our clients money to are turning around and then beating me
Buying real
out
estate.
on real estate deals all over the country. And I'm like the dog underneath the table trying to get a scrap because I can't compete with the purchase power of some of these companies. And because they're building cash flow for them, especially insurance companies. That, like, my goodness, like, how can life insurance companies not have a problem during COVID?
No,
What
yeah,
they what
exactly.
what they insure is life. Life is dying. CNN's got a scoreboard on every single night on how many people died of COVID, and the life insurance companies are flourishing during a life-threatening pandemic. That doesn't even make sense. But once you look under the hood, you like realize how you probably stayed in a hotel that's owned by an insurance company. You probably shopped at a shopping center or a mall that's owned by an insurance company. They have so many assets that are creating cash flow that, yeah, they can weather even a global life-threatening pandemic. And I'm not saying they're doing anything wrong. I'm saying they're doing things right. It's just not likely what they're telling their insurance agents that want to sell all the product all the time what to tell clients. So again, there's that do as I say, not as I do element to the system. And I'm just one of the few wealth advisors I know that are willing to say this kind of stuff out
It's
loud.
the same with my stockbroker. I love him to death because he's made me a lot of money in the stock market. In the last few years, we almost doubled or tripled my initial investment. But he's also, I'm a stock guy, so I don't understand you real estate people. He always tells me that. And I'm like, it's cash flow, my friend. It's cash flow. That's what real estate is for. You grow 3% in a year in your basic price of a home. Okay. It grows by 3%, sometimes a little more, sometimes a little less. But average, it grows by the appreciation of the inflation. And at the end of the day, that's not really your big moneymaker. Your moneymaker is your
It's
revenue
cash
that
flow.
it generates. And that
Right.
cash flow that comes in gives you more leveraging power because now your numbers show that, let's say you're making 10, then 15, then 20,000 a month from your residential income or commercial income from investing into those properties. Your stock portfolio doesn't show you making money. It shows you once a year when you do your tax returns, that, oh, I made this much money on my stock portfolio, which is great, but it doesn't show cash flow as an asset of a residential income property, correct?
But I would say the mindset needs to be different there because people are trying to put an expectation on something that it shouldn't have the expectation. In my opinion, it's more about the portfolios of market based assets are great and they do what they should do. I just don't have an expectation of that. It's not capable of doing, right? To have a dividend income stream coming out of your stock portfolio, you would need so much money. It's
Oh,
crazy.
yeah,
So,
millions of dollars.
so yeah, so you don't have that. I don't have that expectation of it, and I don't expect my real estate portfolio to go up 30% in a year. So there's expectations, but to your point, and I think is what's not brought up enough, right? Is let's say the appreciation on the real estate is 3 to 4%, right? Let's
Yeah,
just say that, okay? But what is the 3 to 4% of, right? It also includes the money you borrowed from the lender or bank, right?
correct, correct.
If you put $200,000 down on $1 million multifam, right, and it went up 4%, that's 4% of $1 million, not 4% of the 200 grand. So that leverage can create higher capital, can create good capital appreciation on that asset. But how did you get the $1 million loan? Oh, you got it because you had so much money in the market based assets, which qualified you, and you used $200,000 as a down payment from that from the market based assets. And now you have X percent going on over here, hopefully, right, in the market. And you also have X percent going on over here in the real estate, and the cash flow from the real estate you're enjoying your life with now, not 30 years from now. Right.
Correct.
So that is a big disconnect I see in the public's view of both markets, both real estate and the market-based assets. They think it's a verse, right? Real estate versus market-based
The
assets.
market.
I'm
It
saying
should
no.
be combination.
And
Yes,
it's it
hand in
is
hand. Yeah.
it's a real estate can be a great amplifier for your market-based assets. It's not a verse.
Correct, correct. I was just thinking about this as well, that when you're putting your money into a market-based asset, you're betting on other people, basically. You're betting on Apple to do well, you're betting on Tesla, whatever. But when you're buying real estate and you're leveraging that from your own, you're betting on yourself, because you're gonna go in there and turn the property around or get it rented out and make sure it's functioning right. hiring the right people to manage that property for you, et cetera. So you're betting on your own business, basically, which is, if people like to control things, that is, you're way more in control there than you are in a market-based asset. That's one of my opinions. I think that is true. What do you think about that?
I just think it's still, I think it's just more of, again, there's an and to it, right? So the expectations got to be different on the both things, right? Yes, you have more control over the real estate, but you have control of the stocks too. If you wanted to pick your own stuff and trade and do all that, good luck to you, but you could do it, right? But I think what people could do is really, especially people that don't need all the knowledge in both subject matters, right? You can hire the knowledge, right? You can hire somebody to handle your market-based assets, and you can hire property managers to help you with the real estate as well. And it doesn't need to be all this, you don't need all this knowledge that I think stops people from even getting involved, and they get this squirrel mentality where they're like, they can't figure out go right or left, and then they go nowhere, and then the economy just crashes into them. So once they can get over that and not feel like they need to control absolutely everything, but have a system that's over, especially over time, that's likely to work. There could be some problems. Actually, there could be. There are going to be some problems along the way, but just changing the attitude and the mindset, I think that can be great. But if that's not you and you want to stick to checkers, please play checkers. Please, just nothing sucks more than being a bad checkers player. You'll get your butt whooped by capitalism. It will run you over. So if you're going to play checkers, fully fund those retirement accounts, stay out of debt, have a good emergency account, have a good college savings plan, have all the boxes checked, but just don't go screaming at the moon, why do the rich keep getting richer and I'm not?
So now the next part where some ears might perk up or panic. Let's talk about debt. Okay. Why do you believe debt, especially in real estate, is not the enemy?
Because it's the best amplifier. You can accelerate the wealth a lot quicker with debt. It takes too darn long to save $1 million. It doesn't take nearly as long to save 200,000 or enough money for the lender to be willing to give you the loan. And debt has great tax benefits, even especially with real estate, right? And they want you to do it. Once you realize that the government wants you to do it, begs you to do it. That's why they have the thing called a tax code. It's a whole thing. It's a whole book of incentives, of reasons why you should invest the way the government wants you to invest your money. Now, you don't have to invest this way. It's a free country, but the government's going to tax the bejesus out of you because once you realize that using the tax code to your advantage is a mutually beneficial relationship with the government. As soon as that seeps into here, worlds open that you weren't seeing, you weren't noticing before. So yeah, so debt can be great. Debt is like fire. If you use it well, cooks your food, heats your home, it's great. But if you use it incorrectly and you can just let it do whatever it wants to do, you don't control it, burns everything to the ground. So it's a great tool for building wealth. You just have to have either hire people that know or learn how to use it correctly.
So, can you explain the difference between good debt and bad debt in real estate world?
The whole good debt, bad debt thing is a little bit murky right now. So I'll explain what I think is a good use of debt and what is a poor use of debt. A good use of debt is being able to obtain debt that somebody else is going to pay for. All right. So Lance, if let's pretend as a third person here and we'll call him Steve right now. How much money would you borrow from me if Steve was going to pay it back fully?
As much as I can.
Oh, there's the answer. And a lot of people get that wrong. You're like one of the few people I talked to that's gotten it. It's as much as you could, right? Yeah. It's not like a number. It's as much as you could because Steve's going to pay it back, right? You're
Correct.
not. Of course, in the real world, we don't know if there's risk involved. Steve might move out, not pay rent, or the business could falter or whatever. But once we understand that, so if we're using debt and someone else is going to, or something else is going to service that debt, whether it be the real estate property, the business, that's a great use of debt, in my opinion. What's a bad use of debt is borrowing it and you having to pay it back out of your own income, right? There is no other thing that's
So don't
paying
buy
it back.
yourself a boat, a fancy truck. I don't know, toys that cost you money. Go buy real estate that pays. And until your cash flow is large enough to carry your toys are
That's right.
last things to get.
So I'm okay with buying the boat. There's a lot
Yeah,
of
yeah.
other advisors. They never buy a boat. It's a depreciating asset. You know what else is a depreciating asset? Life. So let's start living. If you're a boater and that's what makes your heart sing, you know, it's okay to buy a boat, but let's buy the quad first. Let's buy
That will
the
pay for the
apartment
boat.
building first. That pays for the boat, and that's a great use of debt twice, right? So you're using debt to buy the cash flowing asset. You're also using debt to buy that boat, right? So you're going to borrow money to buy that boat. You're not buying the boat cash. So the income from the asset is paying for the liability, which is the boat, right? So that's covering an asset with a liability. It's not like a new concept that I made up. It's just not being explained to the middle class, especially the middle class, as well as I would like it to be.
Awesome. I know we touched on this a little bit, but wealthy investors actually use debt to increase their cash flow. Could you elaborate on that? How they do that exactly?
Well,
Besides the just the property investments, is there anything else that they do?
businesses,
Uh-huh.
buying businesses, buying a business that's going to cash flow, buying correctly, buying existing businesses, buying something that's going to work. I like people have this,
Laundromats, car
yeah,
washes.
something that's it's pretty in every economy, up, down, sideways. It's going to do either okay to really good. So once you get, but that's again, business is not for everybody.
No,
So
no, no, no. You gotta,
that takes a certain person, right? In my opinion, the real estate people they're much more able to wrap their minds around the real estate purchases, right? Certainly once they understand it. But there's the tax benefits. How do you keep more of your money, right? And owning a business is a great way of doing that. But I also want people to understand why, right? Why do businesses have such good tax benefits? What do you create if you start a business? What can you create if you start a business? You can create jobs, right? And what kind of jobs? W-2 income jobs. And who gets hammered in taxes more than anybody else? W-2 income earners. So the government's basically, okay, I'll give one person a strong tax break so they can create several other people with W-2 income, and I'll hammer them. So it's understanding why the tax codes are there, and using debt to be able to achieve that is great, but we have to have the assets. We have to have the market-based assets. I shouldn't say have to. We should, right? We should have the market-based assets to be able to cover eventual problems, right? So you're not driving down the highway at 500 miles an hour and one little rock sends you into the woods, right? So we need to be able to deal with problems, whether that being a business that maybe becomes slow, maybe it's seasonal, during seasons, right? Or COVID or something out of your control happens. You need to have money. You need to be able to put some money on, like money would be like a bandage in that scenario. You got to be able to plug a wound for a little bit until that whatever that problem is heals. And but developing the assets to be able to achieve the debt is, in my opinion, one of the hardest things people can do. It's difficult. It's
got you.
difficult for everybody. It was certainly difficult for a police officer to do it, right? So I understand. Believe me, I've been there. But once you do it and you're able to duplicate it, oh man, it gets pretty big pretty quickly.
Could you share an example of someone, maybe a client or yourself, who used strategic debt to build serious wealth?
Yeah, no, one of my police officer clients, he worked a lot of overtime. He's getting hammered in taxes, and so we started doing some strategies that have really helped with that. And now he has a very large market based portfolio and starting to get a really large real estate portfolio. And the combinations are really helping him out. And it's so he's able to build, and he's in like his late 20s, early 30s. So it doesn't take it might take years, but it doesn't take 30 friggin' years. It doesn't take that long if you're doing it correctly. But the world is telling you to just sit and watch financial grass grow for 30 years while they turn around and, you know, outbid
Quadruple their
you
money. Yeah.
and outbid you on your first house, right?
Oh yeah, that thing that happened a couple of years ago. I
Yeah.
actually interviewed one of the guys that his partner was a CEO for Blackstone down here during COVID times. I got some sort of not super insider, but as much insight as you could get. I was like, yeah, we were making 100, offers a day on buying houses, just sending out offers. It was insane. Blackstone buying up how much property they bought up. It's insane.
I want people to look at the strategies and just shrink the scale, right?
Yeah.
My son plays 14U baseball. He's going into high school. He's a pretty good baseball player. He's not in the major leagues, but he uses the same strategies and the same fundamentals and the same things that the Tampa Bay Rays use, right? We're in Tampa. The game's not different. It's a scale issue, right? It's a scale, but they don't turn double plays any differently than his team does. But in the financial world, there's two totally different games. And in my opinion, checkers is really being oversold, but there also is, in my opinion, a level of paternalism to it. So it's not coming from a place of greed and evil all the time, right? But there could be a level of paternalism where it's Lance, chess would be too hard for you. This it'd be too hard. Stick with checkers. Let the adults play chess, right? Let the big boys play chess and make all the money. You just play a little checkers game and be happy with that.
There's a perfect example of that, though. Just recent history, 2008. Everybody started playing chess suddenly because you can buy a house. You just put your name on the dotted line and you get a house. And then what happened? Yes, it was greediness from the banks. Of course it was. But it was also not thoughtful by the average Joe. It's like, how much mortgage could I actually carry? As you said, over leverage. Like I'm buying house after house and they're all $400,000 or $500,000. At a certain point, that's way too much leverage for a teacher to carry or a policeman. Come on, you got to have that. When you do that, you got to have that backing. As you're saying, you have to have that backing in the market to be able to put a Band-Aid on it if you need to, and then a crash won't happen again. So the next part, we're going to talk a little bit about mindset. A lot of our listeners are agents, investors, or even families trying to build something. If someone's living paycheck to paycheck, how do they start thinking like a wealthy investor?
Start thinking like a wealthy investor. That's where you start. I'm not saying do anything yet, but start thinking and start getting that into that mindset. And somehow, and this is the hardest part, in my opinion, is create that surplus, right? Live in such a fashion that you can create a surplus. I know it's difficult for a lot of people, but once you are able to create the surplus and you don't have lifestyle creep, you don't have other things that affect being able to switch, right, over to chess. As soon as you get that surplus and you're able to get the first loan, you have a little down payment, you start and just build on that. It doesn't take forever, but it can take time. And even look at their skill set. What else could they do? Or how else can they create value? But working more hours doesn't do it. I've tried that as a rookie police officer, working 1,000,000 hours. That, in my opinion, doesn't work out very well. Your relationships suffer and your mental state suffers. And just being able to create that surplus. And that's so much, Lance, that's so much easier said than done. I completely recognize.
I've been doing this since I was 19. I was a financial advisor in Hungary. One of my friends dragged me into it. And I'm really grateful for him because the first thing he gave me was Robert Kiyosaki's book of the cash flow quadrant. Read this. Okay. Now I understand that I am just in cube A. I am basically working and changing time for money. And then the next step is when you actually own a business, you're still changing time for money, but you're making more money because it's your own business. Next step is you're hiring employees and you're leveraging your employees to make you money. And then the last and final step is where you want to be is when you're leveraging your money to make more money. And that's the best. And I was like, it's been engraved in my brain since then. And at that time, I started investing and I grew a little money, not too much, like $5,000, $10,000 in 10-year time. But I've done so many other things since then. that made a lot more money. But I started investing in a life insurance policy at 19 with 20, $30 a month to start doing something that's going to reap some benefits down the line. It wasn't the right choice of investment, but it was something that I could do. And Hungary doesn't have the options like the US has. Like over here, it's incredible what you can put your money into once you become 18 years old. It's insane that you're basically the world opens up for you. Over there, there's no real stock investing going on, at least not on that level. You don't have a Robinhood on your iPhone to buy stocks. It's just a totally different world. So the life insurance was probably the best choice at that time in that sphere where you could put aside money. Yes, if you die, pay some nominal fee, whatever it was. But it was mostly about that it was with Generali. It's a pretty big company in the world, their life insurance company. And they invested the bulk of the money that was put into a fund, an ETF or something that had to grow. And I think I probably invested 2,500 and I got 5,000 out of it recently, like last year. But it wasn't that point. The point was that I started doing that. So I trained my brain. That money that goes there automatically got sucked out of my account, okay, every month. And that money's after you start putting money aside like that, you realize that you don't really need that money. And that's where mindset comes in, and my mindset shifts. Like, oh, I can't live off of this much money. But you can. That's the thing. If you're forced to live off of $100 less a month, you can make it happen. And that $100 can go into that account that will grow little by little until you reach the point where you could buy properties. That's the thing. You got to have that mindset. Let's say you make $2,000 or $2,500 a month. Okay, your rent's $1,000, your food cost is $500, your car costs you $500. You still have $500 left. Instead of going to the movies and go to the bar 5 times a month, you could put aside that $500 and put it into an account where it can grow for you. And that's monthly, let's say. Okay, so in a year you got $6,000. In 2 years you got 12, and you get pay raises, you get a better job, et cetera, et cetera. So there's a lot of factors to that. And I think that's the best way of thinking is like, hey, how much is the necessary money I need to live off of? And what's the access I have on my paycheck? And let's put that access into something that makes sense. Beginning.
I definitely agree with the surplus. Having a surplus is going to really help. And like I said before, like playing checkers first is not a bad idea, right? Yeah. Playing good checkers first. But having also, while you're doing that, having the mindset of I'm going to switch over to the chess, right? So you still have the chess mindset, even though you don't.
Oh yeah. You definitely need that. No, I agree. Yeah. You definitely need that. It's just how to get to chess. You got to play checkers before you can play chess. You learn checkers when you're a kid at 6 years old or 5 years old. I know I'm teaching my daughter chess already, but it's more of a cool horsey jumps in an L shape. Figuring out how to actually play the game is much harder. And every time she has a financial question, I burst him with this financial information knowledge, and she's sitting there and I don't understand a word you said that. Yeah, I know you're 6, but one day you might pull it out of somewhere that daddy said this. Tell me a little bit about daily habits or mindset shifts have the biggest ROI in your opinion, and why is that?
I would say having the end goal in mind all the time.
Okay.
Just have the end goal. What are you trying to do? What is your goal?
Like a vision board would be a good idea to do.
A vision, however that's going to work. I think everybody has their own way of doing that.
Yeah.
But I think it's like, this is why you're doing it. The how isn't as important as the why.
The why, yes.
So if you have the why done and you don't deviate from that and get the most important thing done first.
Yeah.
So when you have like a checklist of a day, which you're trying to accomplish, in my opinion, whatever is the most important should be number one. And that's the thing that you should be doing first. Even if the things on the lower list you can get done quicker and you could have more things done by the end of the day, because let's face it, a lot of us don't get our checklists done by the end of the day. But I think it's not great when people start, like if they have 10 things they need to do, they get 5 of them done, or 7 of them done, but they didn't get the most important thing done. Get the most important thing done.
I have a great analysis, not even an analysis for that, but I've just recently watched a podcast on this. It was one of the sharks from Shark Tank, and he was talking, he worked at Apple at the beginning, and he was talking about signals and noise, how to separate them and make sure you spend most of your time on your signals and less on your noise. As you said, let's say you have a task list of 15 things, but from the 15 things, 5 things will get you ahead of the game. 10 things will just, I got to do it. It's not really making you get forward in the game. Taking out the trash, let's say, could be a noise compared to making that phone call to your client about a showing. That could be a sign because you need to do that. And I think that's a great analysis. And one more plug, I love Simon Sinek too, and he has a great book, The Why. I would highly recommend that to anybody to read it, to figure out your why. Because as you said, the why is one of the most important things because you need something to look forward to. And that why could be a better life for your children, a better life for their children, grandkids, or anything. But it has to be a big thing that will motivate you to get up and do it again and again and again. No?
Yeah, and I even be more specific, in my opinion, on what
The
that
why
better
is.
life looks like. What does
Yes.
that look like? What does that even mean? For some people, it's getting out of an apartment and getting into a single family, even renting a single family place where their kids can enjoy a yard or something.
That's a
It,
big step.
that's a step. Or it could be, okay, I'm buying a lot of single family properties as investments, but I want the multifamily. I want to get into multifamily and focusing on that and get around people who are doing it. Go around Tampa. I speak to, and I
Area
run a lot of
meetings.
groups. Yeah,
Yeah.
there are a lot of pretenders and some players. Try to identify the players, people that are actually doing something and doing it well, and ask them and start getting information from them and hire a team. Once you get to a good spot in life, hire a team, hire a good wealth advisor, hire a good real estate agent if you're not one already, because I know your audience is a lot of real estate agents. Hire a good tax professional. Get more knowledge around you, so you're less likely to step on landmines, right? And if you're making a mistake, make a mistake on something small with a small percentage. This way, you don't make the same mistake later on a much larger number. Even if it's the same percentage, it could be of a much larger number. So yeah, just getting in those mindsets. And sometimes might be the hardest one to overcome. Not taking financial advice from people who love you. That
Yeah,
that one, it could be a real big hurdle to overcome for a lot of people.
definitely. And I 100% agree with you. I would put one maybe change in that would be that unless they are super successful at doing what you're planning to do.
Oh, okay, yeah. So like, yeah. So
If they're a
if they
family
are
member,
successful, I'm talking about people that are like
yeah,
in the same spot
just
as you,
exactly
or
like
they're like
don't listen
not
to
on the same
people on the
page
same
as
level as
you.
you. Try to
Right.
hang out with people further in the game so you can listen to what they have done and how they have failed forward, etc., etc. So you can
Exactly.
learn
So
from their mistakes and their because not every family has. Like my dad was, he didn't even do high school. I think it was 8 elementary, and he managed to build multiple companies and succeed in life back in the day. And I every word he said, he really thought about what he said to me. And I was like, God, it's like suckling on something amazing. And I'm like, how did this guy that was 15 went to try to escape the country? It was a revolution in Hungary back then, 1956. He fought against the Russians. He tried to escape, went to South, got caught, was in a gulag for 2 years. From that kid, how did he become what he became, the multi-company owning successful person? I don't say we were super wealthy. I say we were like upper middle class compared to most of our surroundings. There was one thing that really stuck with me. He said once, we were sitting down watching Dallas or something on Friday, and he was like, from nowhere, he just pulled this out. I've been thinking, if we really needed help, I don't think we have anybody that could help us right now because of the bigger the financial burden, the bigger the problems. Oh, I just need $100 to pay my rent, or I need $50,000 right now to plug some holes in my business. That's a totally different ball game. So you could get to that level. Surround yourself with friends that are at that level. Hey, Joe, I need 50K. Oh, yeah, here you go, man. It's tomorrow. Give it back to me next week or next month. We'll talk about
yeah,
it.
definitely improving. Having your circle become larger it's important, but it's in my opinion, is more mindset stuff. Once you decide that you want more, and it's also okay to want more. Once you decide that and you start doing the things that it takes to achieve those levels, I think it happens very quickly. It's when you're like sticking your toe in the water and pulling it back out, sticking it out. It's like that, you're kind of going nowhere. You're getting older.
Definitely, look, I can attest to that. Mindset is huge. When I was on my flight coming over to work for Carnival Cruise Lines, I'm an American since birth, so it's not like I wasn't raised as American. My mom's American. I was raised in a different country though, so different education, different mentality, different kind of politics. It's a lot of different things that you bring here with you from there. Although I every weekend I was in Boy Scouts, et cetera, et cetera. So I did all the American kind of stuff. But on my flight over here, I was reading The Secret, Law of Attraction, and that's also a mindset book. And that book got me to the Money Master the Game book, which is written by Tony Robbins, and then Unshakable, then furthermore into Kiyosaki and all the other people, which you grow with each book you consume, and your mindset opens up from, oh, I can't do that. I'm not good enough. There's no way I'm going to get out of this rat race to, dude, the guy did it.
Yeah.
This guy with the big teeth, like Tony Robbins. Oh, he has a $7 billion net worth right now. And he had a time in his life where he didn't have money for a sandwich. But he made it happen from reading books and growing in mindset. He made himself aware of his surroundings and how to do this. And that's all it takes, guys. It's all about mindset. It's all up there.
Especially like realtors. Like I know your show has a lot of realtors, and realtors can be one of the hardest challenges because especially the ones that just want to learn all the time. Like I love them for it. I see them in the Tampa area a lot. They just, I want to learn more about this. I want to learn more about that. Learn more about this. I'm like, okay, great. Have you bought something yet, though? Oh,
yeah.
Oh no, because I don't feel like I know enough yet. I'm like, no. You got to start taking some action. You got to start doing something. And again, starting small is okay because you're going to learn while you do it. And as long as you can
it doesn't have to be the perfect deal either. It doesn't have to be the perfect deal. Like every box checked out. It could be an okay deal where you're still cash flowing. You could still bump up the rents a little bit. You can fix up the place a little bit, get some more equity into the property. It doesn't have to be, like my first deal, and I'm not kidding you, was a perfect deal. I bought my fourplex at $165,000. It was insanely like $43,000 a door.
Where was that?
It's in Daytona. I'm across from you, by the way. I'm not far from you.
When
I bought
was
it in
that?
Daytona. Sight unseen, nothing. I researched it. I was in Miami. We were planning on moving away from Miami because baby was on the way. We were like, where are we going to go? Sarasota was one of the places. Couldn't find any property there. And I found this fourplex on Redfin or something. And I was already an agent. I hired a local agent though, because I said, look, I don't know the market. I don't know anything around that area. I don't know anybody there. And I don't want to keep driving up 3.5 hours from Miami to do this one deal. And I was also planning on going on a vacation for a month. So I was like, hey, can you guys help me? I hired a local agent. He's awesome. Sean, I interviewed him too. He's a big commercial agent now. But it was one of his beginning deals, which was awesome. And he was like, Lance, this place is a shithole. Yeah, I kind of get that for the price. Is it block? Yes, it's block. Okay, that's good. That's what I want. Okay. And what kind of roof does it have? It's called like a California roof. It has like pebbles all over it. So I'm like, okay. Does it have a pitch? No. I'm like, I didn't really want a flat roof, but you know what? It's okay. It's 4 units, 43,000. It can't be that bad. It's already generating $1,600 a month in rent. So I'm like, I could probably swing it and raise the rents a little bit and update the place. Okay, when I got here, man, I was like, I sent my inspector up here to inspect the property. He was like, Lance, man, this is a rough shape. But it was block, and it was nothing like every unit needs a new kitchen. Every unit needed to update a bathroom. But they were all one bathrooms. Some of them were 2 bedrooms. 2 of them were 2 bedrooms. 2 of them were 1 bedrooms. But I was like, look, I'm going to go up there and sink some money into this. I think we put in a combined like $50,000 into the renovations. We updated the electrical to have 100 amps in each unit because it was 50 amps in each. It was like nothing, man. We did that. We did that. That was the biggest expense. That was like $8,500. And then we found on Marketplace kitchens that people were selling in Orlando. So we hired a U-Haul, drove down, bought the kitchen for $100. And this is from a house that's worth about $600,000-$700,000. So you could imagine nice solid wood cabinets. What we put in the Corian countertops. I got this LVP flooring throughout the units for $1 a foot. I laid all the flooring. I did all the plastering. I did all the painting. I did all the cabinets, changed the bathrooms out. I had one helper to help me with things, but we did all the work pretty much ourselves. And now the property's worth $500,000 and it's yielding $5,000 a month.
Yeah, especially if you can do the work yourself. That's great.
I'm like, it's insane what you can do. And this was 6 years ago. So it's what you can do when you put your mind to it. But I was also on the fence because I was reading books after books and I was like, I don't know if I'm ready yet. I don't know enough. What are we going to do?
Yeah,
How are we going to do this?
stop that.
No, you got to get
Stop
into
that.
it. It's like I kicked myself in the butt. The kid was on the way. I said, we need to make a move now or we're never going to make a move. And I'm going to keep bartending for the rest of my life. And that's when it happened. And I kicked myself in the butt and my wife took a dive with me. That's also really important that you have your partner on the same page with you.
It is.
You know, that's massive.
Yeah, my wife's come a long way from when we first started buying properties. It was like, I'm not sure about this. I don't like this. About the property, whatever. I'm like, we're not living there.
Exactly.
That's a hurdle for people. And I understand. And I had the same concerns at the time. But now the other day I just walked over to her with my phone and I was like, hey, I'm going to make an offer on this. I want to make sure you're good with it. And she scrolled the phone for 10 seconds and she's like, yeah, okay.
Yeah,
and just walked away. So we have that property on the contracts now. So there are going to be hurdles. There are going to be mindset hurdles. This is so much easier to hear two guys who do it all the time on a podcast, right?
Yeah.
But you got to start somewhere.
Exactly.
But it does take having money. I see it all the time.
Yeah.
I see the meetups like invest in real estate with no money. I'm like, good God, don't do that. If you need
at least 3.5% plus your mortgage costs. So about 7%. I'd say if you have a 10% saved up of a property price, you should be okay because you can still manage a month of non-rent and renovation if you're doing it yourself. But 10% of a $200,000 property is $20,000. You should be able to save up $20,000 somehow to be able to buy your first property.
Yeah, I want people to have at least a lot of the value of the property like on hand. Like I use in my book, I use $1 million as like an example, right? So let's say someone had $1 million, right? And they're like, it took them forever to save this $1 million. So it's hard, right? And instead of purchasing $1 million property, now they take $200,000 and they invest and borrow Now they have $800,000 of market-based assets and $1 million worth of property. And that property is creating cash flow over 10 years in normal market conditions. You're going to have a lot more at the end of that 10 years than if you did either or there. Yeah. Again, it goes back to using debt correctly. But at any point in time, if something went wrong in this scenario, you had $800,000 to be able to weather storms, right? And could pay the lender back if you needed to for a little while. It's just not over leveraging and also not doing anything that I see. And over leveraging, I would say those are the three biggest problems: over leveraging and not doing anything.
Yeah, I mean, you just brought back another memory of that fourplex. My wife, I think 4 days before giving birth, she was cleaning the floors on her knees just to make the property rentable because we were renting that unit out the 1st of January. And she gave birth the 3rd of January. So we were in there December 30th, both of us. I was still fixing things and she was there cleaning the floors and making everything pretty for the first tenant that we're going to officially us renting it out for the first time. It wasn't something we inherited. But that's something too. If you have a life partner that is with you, she's with you. Like that's a big thing. So next question is, what does it take to go from reactive with money to proactive with money?
Oh, besides the mindset.
Mindset.
Yeah, definitely the mindset and a little bit of knowledge base. You need more knowledge base. But you don't feel like you need to go back to school or anything like that. You just have to have some knowledge base and the want. You have to want to do it. I know a lot of people who simply don't want to do it, and that's why it's not happening, right? So I would say those things.
Okay. I know you believe this, but I got to ask this question. Do you believe anyone can become wealthy, or is it only for those with a head start?
Oof. How are we defining wealth?
Oh yeah, that's a good one. In this instance, I think it's more monetary, but I think wealth is not just money, of course. It's your
Oh,
lifestyle
okay,
as well.
let's. How many dollars are we talking about then? If
I
we're
would say a comfortable you would so in today's world, if you make over $100,000 a year, sorry, a year, you could live fairly comfortably, I'd say, without the oh my God, what's going to happen tomorrow? I'd
I,
say 100K in passive income a year would get you wealthy. In my opinion, that would be like, okay, I can, if I break my leg and I can't go to work, I still have the income coming in that could support the family and everything else.
I would still say you're still playing check. That's a good game of checkers, right?
Yes.
So when you're able to be able to withstand emergencies and still save money, all that, yeah, that's really good checkers. To be wealthy, if you're gonna be able to invent a killer app, right? That can do it. Again, like I said before, being the right place at the right time as far as like a startup and getting into an ESOP program, a company that kills it, or you start investing in real estate and businesses. I just don't think it comes any other way. I don't think you can really become wealthy. Just you can't. In my opinion, you can't do it with a salary. It's just without
Monetarily,
doing
no, but you could be like the Dalai Lama and become wealthy.
that. So it's
That's a
actually
different
how we're
wealth.
defining it, right?
Yes, that's why.
And
So,
I also say you could be happy playing checkers, right? And
yeah,
you can be like, I don't want any of that stuff, and I'm going to be happy playing checkers. Then you have achieved your goal. I wanted people to know that there were two different games, and I wanted them to know which one they were playing and whether they wanted to continue playing that game. So it's but being happy is the most important part of all of this.
so broke it down a little bit financially. So if you have $100,000 and a year, you divide it by 12, you say 8,333 a month. So if you make $8,333 a month, about there, let's say 8,400 bucks a month, that would make you, I think, in a sense, comfortable and not super stressed about money.
How are we earning this money, and
So I would say
how's it taxed?
passive. You want to have you. I would
Or
say
passive? Okay.
to make this money passively a month, 8,400 bucks, is where you become that point where you're like, I am not stressed about money anymore. I don't have fights with my wife about money anymore. I can support my children's athletic adventures. We can go on 2, 3 vacations a year, et cetera, et cetera, et cetera.
Is this in addition to other income?
Yes, this would be
Oh,
your
okay.
passive income. This
But
would
it's
be
in
your
addition to
passive.
active income.
Yeah, exactly. You have active and passive. This would be your passive income that if you say, I'm
Okay.
taking the next month off, I'm still making this money no matter what.
Okay. All
If I
right. All
don't
right.
make
All
a
right.
phone call for the
I
next
thought
two
you were just
months,
saying that amount of money just
no, no, no.
passive. Like, oh,
No,
it's
that
not
amount of money
enough.
passively is what I think that gets you to the point where you're comfortably thinking, like, I'm almost there. Like, I'm close to it, but I'm not there exactly, but I'm almost there. So I'm like, I know that I'm still a little stressed, but I'm not like that stressed. I know if I reach this number, I will be definitely like, look, if I go on a spiritual journey for a half a year, I won't be panicking about what's going to happen to my family.
Yeah, it's going to be different for everybody. And the what ifs are going to bring what are
But
people comfortable with?
put it together, how much a mortgage costs. Let's say it's right now it's high, so 2,200 bucks for a 3 bedroom house or a 4 bedroom house. Then you get your monthly living expenses, your utilities, your food, all that stuff. You add that to another 1,500 bucks. You're looking at maybe $4,000 at that point. Then
Yeah,
you add
you're talking about the cost of goods and services line that I was
pretty
referring
much
to again. So
exactly.
once you get above that in passive income, you're going to feel a lot differently.
Oh yeah, I think that's where wealth is established. Because once you have that in passive income, you're pretty wealthy at that point. In my thought, because okay, I could pay for my life insurance, I could pay for my cars, I could pay for my insurance, I could pay for my house, I could pay for my utilities, I could pay for this kid's schooling, I could do everything, and I don't even have to go to work today. So that's wealth. To achieve that, so 8,500 bucks, logically between you and me that invest in real estate, guys, this is about 4 to 6 properties paid off,
Yeah.
fully
Yeah.
paid. So 4 to 6
Fully paid
properties
off.
fully paid off. If you're looking at it with debt scenarios, you double that or times and a half or double. No, you double that. So let's say it's 12 properties and you would be at this point. So that's 12 properties. If you buy a property a year, in 12 years, you can achieve that goal.
Yeah, it doesn't sound bad. I still want people using the debt though.
Of course, using the debt.
Continuing.
That's why I'm saying 12 years using the debt. That's why I'm so the reason why I'm doing this, Freddie, is to put a number and an idea in people's heads about it's not as hard. It doesn't take as long as you think it will.
Yes, I was saying that earlier. Yes, it doesn't take as long as people think it does. Yes. Absolutely.
No.
But they also, in my opinion, need to know that the first one sucks.
Yes.
The first one is miserable. It's just, I just tell people, imagine being thirsty and all you have access to is a leaky faucet and it drops like one drip like every 40 seconds or something like that. And you just got your head underneath it, but you're dying of thirst. That's what it feels like, the first one. It doesn't even feel worth it. It's the next one and the next one, the next one. Then
it
you
starts
like
flowing.
Yeah. And then next thing, you have more water coming out of that faucet that you can drink, and you have an overflow. And that's where but that first one is
I think that's where your analysis about the checkers and check comes in, or checkers and chess, is when it starts flowing. Now you can start playing real chess, because now you have the buying power of that flow of cash flow basically coming in. And now we could go, okay, so I have 12 single family units that I bought in the last 12 years, moving from town to town as a veteran, let's say, for example. But now I have enough cash flow coming in that I could buy a 10-unit multifamily. Boom. Right. That's the game changer.
And another thing that people also need to realize, that when you have that many properties, the down payments aren't as important anymore, because you can cash out refinance, you can take out a portfolio loan, and you don't even have that initial down payment that comes out of feels like it comes out of your pocket, creating the debt for that multifamily property that you're talking about. So worlds do open up, but it's good that the journey is going to be different for everybody, in my opinion. But it's really just getting people to start and believe that they can do it. But I also caution people, having the market-based assets is still very important.
That trickling that comes in, let's say you're cash flowing $500-$600 a month on your first property, which is not bad, but you can't really do a lot with it. But what you can do with it is reinvest it. That could go to your market-based assets and sit there and make more money for you. You can't really buy a new bathroom with it, or a new kitchen, or whatever. You can't really improve the property with that money. You can't really use it for a lot of things. It's $500-$600. You still have your active income that should support your family. That $500-$600 though, if you put it into the market-based assets, it starts growing that account. Here you go. Here's that $500-$600 I was talking about a little bit earlier. Coming from your first property, somebody else is giving you that money to invest.
Exactly.
Boom.
And then next time you go for that loan, you should be able to get a bigger loan, because now you have more market-based assets to qualify for an even bigger loan than you did the first time. Yeah. Like all these strategies, we agree that they take a little time and a lot of effort, but they don't take 30 years. Definitely. They don't.
I'm 37. And I've been in the country for 11 years. Okay. And I reached what I reached in the last 11 years because I came here with $300 in my pocket. So it's very doable. You just have to stick in there and keep working at it, and just keep improving yourself and getting towards a better and better savings agenda and all that stuff.
And I say over leveraging is a real risk, and it is. And it happens to people that you just didn't think it was going to. And all of a sudden they see a life hack, and they like, why am I doing this? I'll just buy more properties. Wait, no. You still want to play the game right and be able to have all the market-based assets, have all the stuff that you need to not over leverage, because man, that house of cards comes down quick. And I've seen it a million times. I just seen it recently with all of a sudden the Airbnb guys just went up and they just went away. Where's all the Airbnb guys go? Where'd they go?
I'm getting fix and flippers now a lot. Like I
Yeah,
used
it's
to
like,
have, hey, I'm looking for a short-term rental property in your area. You get those text messages every day if you're a
mm,
realtor. You're not a realtor. I get them all the time. So now I'm getting all the flippers text. Hey, I'm just looking for a property for me and my wife. We're looking to fix it up, blah, blah, blah. They're all these big companies sending out mass text to
right, yeah,
agents looking for properties to flip. And I'm like, guys, I know you're fishing for a property, but why are you trying to call agents on this? To be honest with you, we are hired to get the maximum amount of money for our clients,
right,
not to sell their homes for dirt
right.
cheap that
It's like
you're looking
conflict of
for.
interest.
Exactly. Like that's the absolute opposite of what the code of ethics says. What you're trying to do. Make an offer then on
Yeah.
any of my listings if you want to, but that's probably the best thing you can do. Let's get into the next topic here. What's next for you and Opta Financial? Are you expanding your educational tools through playing the wealth game or anything else?
We're really focused on getting the message out and getting the right people. We want the right clients. We want to work with chess players and getting people to understand how we're different than your standard wealth advising firm or financial advising firm. It's different, right? So being able to separate from the standard is can be challenging, but that is our goal. Our goal is to make sure that people understand if they want to play chess, they need to have a chess advisor, not a checkers advisor, in my opinion, because they could be really good advisors, they could be really good checkers advisors, but they're not going to be able to, in my opinion, to be able to help the way that a chess advisor, someone who lives and breathes it, is going to be able to help somebody. That's our goal right now, to really get that knowledge out there, get that information out there, and work more chess people.
Awesome. Are there any tech tools or AI platforms you've started using in wealth strategy or real estate planning?
Lance, the rules have been the same in our industry since 1940.
Okay.
Technology is not something that the financial industry is really good with adapting very quickly. A lot of the rules and regs are the same for feels like a million years. But no, we are leveraging as much as we can, but it can be challenging, especially with marketing.
Oh, yeah, for sure. And if someone wants to learn more, where should they go?
You can go to our website, optafinancial.com. And I joke that our website is just as boring as every other firm's website because it has to be for compliance reasons. But just scheduling a call, scheduling a Zoom with us, seeing if during a consultation if we're going to be a good fit for each other. That's the best way. Having those conversations, seeing if we can even provide value, right? Because our assets under management fees are pretty reasonable, but they actually have to be of a number. Being able to really making sure that we're going to be good for the client and the client's going to be a good client for the firm is very important. But that's the best way to go to optafinancial.com and schedule the consultation. Calendly basically runs my life now. It's I own the place, but Calendly is my boss, so it tells me when and where to be.
Awesome. So, Freddie, thank you for bringing the heat today, from flipping the script on debt to sharing strategies that most people never heard about. You've dropped some serious knowledge today. For our listeners, if you want to dive deeper into how to use real estate and smart debt to build generational wealth, go grab a copy of Playing the Wealth Game or visit, oh, there it is, or visit optafinancial.com. You can also follow Freddy on YouTube, LinkedIn, and Facebook. He's got tools and resources that can help you grow your portfolio or better serve your investor clients. Don't forget to subscribe, leave us a review, and share the episode with someone who's ready to stop playing checkers and start building real wealth. You can also leave comments. We'll answer all your comments underneath the video. If you have any questions, you can shoot that to me. Until next time, I'm Lancelot Lenard with the Sir Lancelot Group, signing off from Central East Florida, where strategy meets opportunity. Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.